Welcome to Simple Investing Secrets, your trusted source for valuable investment insights, stock recommendations, and strategies to help you achieve financial freedom. In today's video, we'll delve into the top 7 oil and gas stocks to buy for 2024 success. So before we start, if you find value in this video, please support our channel by liking and subscribing to our weekly updates. Now, let's get started. The recently concluded UN Climate Summit resulted in an agreement urging the transition away from fossil fuels in energy systems, falling short of explicitly endorsing their complete phase-out. The language approached the issue by advocating for the acceleration of efforts toward the phase-down of unabated coal power. Although considered a step forward in the context of such meetings aimed at achieving global carbon emission reduction to net zero, the conference's conclusion was delayed due to intense overnight negotiations on whether to explicitly call for a phase-out or settle for a phase-down of fossil fuels. This highlights the prevailing global hesitancy to swiftly detach the planet from reliance on oil and gas in the near term. Global projections from the International Energy Agency and the Economist Intelligence Unit indicate that demand for oil and natural gas will likely continue to rise until at least 2030. Despite the growing prominence of renewable energy sources such as wind and solar, oil and gas companies may remain profitable for the foreseeable future. While some investors seek to avoid supporting fossil fuel companies based on principles, others aim to capitalize on potential short-term gains in these stocks. It's important to note the inherent volatility in the energy sector, where stock performance often thrives during periods of robust economic demand or in response to supply shocks, such as those resulting from attacks by Iran-backed Houthi militants disrupting oil shipping routes in the Red Sea. However, these companies are susceptible to downturns, as evidenced by the S&P 500's energy sector, returning only about 1% over the past decade. This emphasizes the need for investors to carefully monitor industry dynamics alongside company fundamentals when contemplating investments in energy stocks, whether in fossil fuels or renewables. The composition of energy stock portfolios is expected to undergo changes over time, with the gradual shift from fossil fuel to renewable energy companies. So, we're going to give a rundown on a selection of companies involved in traditional oil and gas. Number 7. Exxon Mobil Corporation. Amidst the gradual shift towards renewable energy sources, major fossil fuel players are strategically diversifying into cleaner technologies like hydrogen and carbon capture, and Exxon stands as a notable example. While Exxon remains predominantly an oil and gas company, its robust financial resources enable significant investments in forward-looking initiatives. This strategic pivot positions Exxon well in the event of potential shifts in public sentiment and market dynamics, leading to a reduction in traditional oil and gas consumption. Water Tower Research highlights the growing investor interest in carbon capture and sequestration, or CCS, recognizing it as a pivotal aspect of the evolving energy landscape. Exxon's active involvement in advancing CCS projects along the U.S. Gulf Coast, particularly in key industrial corridors, underscores the company's commitment to addressing environmental concerns and embracing sustainable practices. Many of these initiatives are anticipated to involve strategic partnerships, ensuring a comprehensive solution in the transportation and permanent storage of captured CO2. Water Tower Research further notes, carbon capture and sequestration has garnered significant interest from investors seeking to understand the commercial aspects of the opportunity set. As the commercial terms of these projects become clearer, investors are expected to increasingly recognize and attribute tangible value to Exxon's proactive engagement in the burgeoning field of carbon capture. Number 6. Occidental Petroleum Corporation. Occidental's prominent position in the carbon capture sector is underscored by Water Tower Research, recognizing the company as a pivotal player. Notably, Occidental is actively advancing its standing by undertaking the construction of a groundbreaking direct air capture, or DAC, facility in Texas. This facility, poised to be the largest of its kind globally, is set to commence commercial operations in mid-2025 with the ambitious goal of capturing a staggering 500,000 tons of atmospheric CO2 annually, as meticulously outlined by the esteemed research firm. Noteworthy is the significant backing Occidental receives from Warren Buffett's Berkshire Hathaway Incorporated, a testament to the confidence bestowed upon the company by the renowned investor. The financial guru, Buffett, is strategically increasing his stake in Occidental, underscoring his unwavering belief in the company's potential. Presently, Occidental stands tall as the 6th largest holding in Berkshire's well-diversified portfolio, further solidifying its appeal in the eyes of astute investors and industry observers alike. Number 5. Chevron Corporation. Robert Johnson, a notable financial expert, advocates for Chevron as a robust investment choice, underlining its significance as the 5th largest holding in Berkshire Hathaway's esteemed stock portfolio. The appeal of Chevron is further accentuated by its compelling dividend yield, which stands at an attractive 4% as of January 2nd. Operating as a vertically integrated major oil and gas company, Chevron's diversified activities span upstream oil and gas production, midstream petroleum product transportation, and downstream petroleum refining and sales. Beyond its conventional operations, Chevron is proactively engaged in renewable energy investments, showcasing a commitment to adapting to evolving industry trends. This strategic diversification aligns with the company's substantial financial resources, mirroring its capability to scale up in the clean energy sector, a trajectory similar to its industry counterpart, Exxon. Water Tower Research, a respected authority, positions Chevron among the companies venturing into the crucial realm of carbon capture, alongside industry leaders Exxon, Occidental, and Talos Energy Incorporated. This multifaceted approach, coupled with Chevron's sturdy position in Berkshire Hathaway's portfolio, solidifies its standing as a promising investment option in the dynamic landscape of the energy sector. Number 4. Vites Energy Incorporated. Water Tower Research has recently initiated coverage on an oil and gas company with a strategic foothold in North Dakota. This company distinguishes itself through a well-thought-out approach, focusing on the acquisition of non-operated working and mineral interests and assets, strategically targeting those either currently in production or on the brink of drilling readiness. Operating with prudence in capital expenditures, the company has successfully generated free cash flow, effectively maintaining low debt levels while concurrently offering shareholders a substantial dividend, evidenced by the stock's impressive recent yield of 9.2%. Water Tower's analysis underscores the importance of Vitesse's low leverage, recognizing it as a pivotal component of the company's overall business strategy. In a separate note, the research firm expressed optimism, stating, "Our estimates indicate that Vitesse could generate substantial free cash flow through year-end 2024 to support management's capital return ambitions." Further contributing to Vitesse's appeal is the fact that senior management members of the company collectively own over 20% of its common stock, a significant factor highlighting a strong alignment of their interests with those of shareholders. This combination of prudent financial management, a robust dividend yield, and a substantial ownership stake by management positions Vitesse as a noteworthy player in the oil and gas sector, according to Water Tower Research. Number 3. Valero Energy Corporation. Daniel Bustamante, Chief Investment Officer at Bustamante Capital, holds a positive stance on Valero, a prominent downstream energy company specializing in the manufacturing and marketing of transportation fuels and diverse energy products. Renowned for its refining processes that effectively transform crude oil into a range of essential petroleum products, including gasoline, propane, and asphalt, Valero has recently bolstered its investor appeal by greenlighting a substantial $2.5 billion share buyback program, notable for its open-ended duration. This strategic move follows the company's proactive approach in the third quarter, wherein a commendable $2.2 billion was returned to shareholders. Within this allocation, $360 million was earmarked for dividends, underlining Valero's commitment to providing ongoing returns to its investors. Simultaneously, $1.8 billion was judiciously utilized in the repurchase of approximately 13 million shares of common stock, reinforcing the company's dedication to optimizing shareholder value. Daniel Bustamante, shedding light on Bustamante Capital's approach, reveals, "While we had a significant investment in that particular company last summer, we decided to take profits. However, we are closely monitoring the macro picture in the energy sector as we enter Q1 2024. This cautious yet vigilant approach aligns with the dynamic nature of the energy market, demonstrating Bustamante Capital's strategic decision-making as it navigates the ever-evolving landscape in pursuit of optimal returns for its investors." Number 2. EOG Resources Incorporated. Distinguished in the exploration and production sector with a focus on crude oil and natural gas, this company has strategically embraced stock buybacks, aligning with the prevalent industry trend aimed at returning funds to shareholders without incurring excessive capital expenditures for production expansion. Demonstrating a robust commitment to this approach, the company executed share repurchases totaling an impressive $61 million in the third quarter alone. In addition to this proactive buyback strategy, the company further augmented its appeal to investors by raising its regular quarterly dividend by a substantial 10%. The financial attractiveness of this energy firm is underscored by its declaration of a special dividend of $1.50 per share, providing shareholders with an extra layer of return. As of January 2nd, the stock boasts a commendable yield of 3%, solidifying its position as an enticing investment opportunity. Notably, Bustamante, a discerning commentator in the financial realm, expresses a clear preference for EOG Resources within this sector. Emphasizing the capabilities of CEO Ezra Yacob, Bustamante notes, "EOG Resources is a preferred choice. CEO Ezra Yacob's capabilities are noteworthy, and the consistent dividend increases and share buybacks underscore their commitment to prioritizing shareholder interests." This combination of strategic financial moves and strong leadership positions the company as an attractive choice for investors seeking stability and returns in the dynamic energy landscape. Number 1. Cheniere Energy Incorporated. The United States has firmly established itself as the world's preeminent natural gas producer, a pivotal role bolstered by its expanding prominence as a liquefied natural gas exporter. This ascendancy assumes added significance against the backdrop of Europe's concerted efforts to diversify its energy sources and diminish reliance on Russian supplies, particularly amid the ongoing geopolitical tensions related to the conflict in Ukraine. At the forefront of this seismic shift is Cheniere Energy, an industry stalwart boasting one of the globe's most extensive natural gas liquefaction platforms, spanning strategic facilities in Louisiana and Texas. Cheniere Energy's proactive stance is evident in its relentless pursuit of opportunities for liquefaction expansion, underscoring a commitment to meeting the escalating global demand for LNG. In a remarkable transformation over the past decade, the United States has seamlessly transitioned from a net natural gas importer to the undisputed leader in LNG exports. Rob Thummel, portfolio manager at Tortoise Capital Advisors, keenly observes this paradigm shift, emphasizing Cheniere's pivotal role as the largest U.S. exporter of natural gas. Positioned at the forefront of this burgeoning industry, Cheniere appears poised not only to sustain its current eminence, but also to play a pivotal role in shaping the trajectory of the global LNG market in the years to come. If you found value in this video, don't forget to support our channel by liking and subscribing for weekly updates. Make informed investment decisions and stay ahead in the dynamic world of finance. For more valuable content, hit that subscribe button now. Until next time.